Just a few weeks ago, Oracle was one of Wall Street's biggest AI winners. The company announced massive cloud expansion plans, signed multi-billion-dollar AI infrastructure agreements, and became one of the fastest-rising large-cap technology stocks of the year. Then, almost unexpectedly, the momentum faded. Investors started selling. So what changed? Did Oracle's competitive position suddenly weaken? Did its AI opportunity disappear? Or is the market simply reassessing how much future growth has already been priced into the stock? In investing, great companies don't always make great investments, especially when expectations become extraordinarily high. That's why, in this video, we're going beyond the headlines. We'll separate facts from market narratives, examine what actually triggered the recent sell-off, and answer the only question that really matters. Has Oracle's investment thesis changed, or has only its stock price changed? Before we can understand why Oracle's stock sold off, we first need to understand what investors were expecting. Because stock prices don't move based on today's results alone. They move based on expectations about the future. In Oracle's case, expectations had risen dramatically. After a powerful rally, the market began pricing the company for stronger growth, continued execution, and sustained momentum. In other words, investors weren't just buying Oracle's current business. They were paying for what they believed Oracle could become over the next several years. And when expectations reach that level, the margin for disappointment becomes very small. That's why understanding expectations is just as important as understanding the business itself. Following Oracle's latest earnings release, investors received several important updates. The company reported continued growth in its cloud business, with Oracle Cloud Infrastructure remaining a major driver of overall revenue growth. Management also highlighted strong demand for AI infrastructure and disclosed additional cloud agreements with customers building large-scale AI workloads. At the same time, Oracle reaffirmed that it is investing aggressively to expand its global data center capacity in order to meet that demand. Those announcements reinforced Oracle's long-term growth strategy, but they also provided the market with new information to evaluate. Following these developments, Oracle's share price came under pressure. The next question is whether that price reaction reflects a meaningful change in the business, or simply a different assessment of its future value. The market's reaction and the company's fundamentals are not always the same thing. To determine whether Oracle's recent sell-off reflects a real change in business quality, we need to look beyond the share price. Based on the latest results, Oracle's core business continues to generate recurring revenue from its database, enterprise applications, and support services. Meanwhile, Oracle Cloud Infrastructure remains a key engine of growth, supported by increasing demand for AI computing and enterprise cloud migration. In other words, Oracle's long-term growth drivers remain in place. The latest earnings did not indicate that customers were leaving, that demand was weakening, or that Oracle had lost its competitive position. The business continues to execute. The question now is whether the market is focusing on something else. That brings us to the issue at the center of today's debate, Oracle's unprecedented level of investment. One of the biggest themes emerging from Oracle's latest results is the scale of its investment. To support growing demand for AI infrastructure and cloud services, Oracle continues to expand its global data center footprint. That requires substantial capital spending today. For management, these investments are designed to increase future capacity and support long-term revenue growth. For investors, however, higher capital spending also raises important questions. How quickly will these new data centers generate returns? Will revenue growth outpace the increase in investment? And when will these investments translate into stronger free cash flow? These are not signs that Oracle's business is weakening. They are questions about timing, execution, and the return on capital. For long-term investors, that distinction matters. Ultimately, the investment case for Oracle depends on whether these investments create value over time. That brings us to the two scenarios investors should consider. Every major investment ultimately has to produce measurable business results. For Oracle, the current investment cycle is built around expanding cloud capacity to support growing demand for AI and enterprise workloads. This strategy requires significant capital today, with the expectation that additional capacity will support higher revenue and stronger cash flow over time. Whether this strategy succeeds will depend not on the amount Oracle spends, but on how effectively those investments are translated into business performance. That means investors should focus on execution. Can Oracle continue expanding its cloud business? Can new capacity be absorbed by customer demand? And can future revenue growth generate attractive returns on the capital being invested today? These are the questions that will ultimately determine whether Oracle's current investment cycle creates long-term shareholder value. Looking ahead, Oracle's investment thesis will be shaped by execution rather than expectations. Over the coming quarters, investors will be watching whether Oracle can sustain strong growth in its cloud infrastructure business while converting AI demand into recurring revenue. Another key indicator is whether the company's expanding data center capacity translates into higher utilization and improved operating leverage over time. Investors will also monitor whether growing revenue begins to offset today's elevated capital spending, supporting stronger free cash flow and attractive returns on invested capital. These metrics will provide a clearer picture of whether Oracle's investment strategy is creating long-term value. Ultimately, the outlook depends less on short-term market sentiment and more on Oracle's ability to consistently execute against its long-term strategy. And that brings us back to the question we asked at the beginning of this video: did Oracle's business change, or did the market simply change its expectations? Oracle's recent sell-off may have changed the market's expectations. But it has not, by itself, proven that the company's long-term investment thesis has fundamentally changed. History has shown that markets can react quickly to uncertainty, while businesses create value through consistent execution over many years. For long-term investors, that's an important distinction. A falling stock price is not always evidence of a weakening business. Sometimes, it simply reflects a market reassessing expectations. Ultimately, Oracle's future won't be determined by short-term market sentiment. It will be determined by its ability to execute its strategy, convert investment into profitable growth, and generate attractive returns on capital. Because in the end, markets price expectations. But over the long run, they reward execution. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.